as we speak, we're also seeing Fed Vice Chair Richard Clarida speaking at an event in New York, and he's just been saying that he sees no evidence of an overheating labor market, that the Fed will act as appropriate to sustain the economy. Are the markets right in baking in more Fed action to come given the latest economic numbers?
Absolutely. No, the question is not so much will the Fed ease. I think they certainly will ease. And we've heard from others today, including Robert Kaplan, right, who said the Fed will do what they need to do. And he's saying that this is a markets guy, after all. He's saying that in the knowledge that there's about a 90% probability priced into the market for the October meeting for a cut. So I think we will get that quarter point cut. What I think has been difficult is that it's been pretty clear for some months that the economy needs a bigger jolt than that a 50 basis point cut would be more effective. And for that reason, the market's gotten what it's wanted, or what it expected, rather, but that they react with disappointment anyway.
But now it seems that it's turning more into a story of what the markets need, given that we continue to see this weakness spreading not only from the manufacturing side of things, but into other different sectors, especially services. Yeah, and I think that's maybe the most troubling. The ISM service index that came out today, as you mentioned, 3-year low. Now, 3 years ago, what that was August of 2016 and a series of hurricanes. So looking past that, you have to go all the way back to the 08-09 recession. And looking at this level, 52.5, above 50 is growth. So that sounds pretty good. But 52.5 is where we were at the beginning of the 08-09 recession. And it's actually where we were about midway. It took about midway through the 01 recession to get there. So these are levels now already consistent with recession. I think it's important to take it seriously, especially since the bulk of the weakness is in the three most important components: business activity, new orders, and employment.
Yeah, Chris, and I guess that the trend is an important consideration too. The direction of those numbers may be a little troubling, but through all of this, and this is a point we've been raising a few times this week, the consumer remains the totem of strength for the U.S. economy. But at what point does this reach the consumer? Is the consumer just going to be the last domino to fall?
Well, it's the only domino standing. So if they fall, then yes, they will be the last domino. But consider, Paul, I think the key here is when you are so reliant on this one component, consumer spending, the key is income. And that income, of course, comes from employment. So we've already seen businesses slash spending to zero. They're not spending. There's no growth at all. But they are still hiring, although hiring has slowed also about 25%, in fact, since last year. So that income weakness is already beginning to develop. And that's one of the reasons I am concerned. And I would like to see the Fed take this a little more seriously.